Welcome to UPSC Vinoth. Today we are going to discuss one of the most important topic for the prelims, that is RBI's monetary policy instruments and repo rate mechanism. See, every year every year not every quarter year you will hear the rate of repo rate, this term. So RBI will always use the word repo rate. So what is this repo rate? Why it is in the news? The Monetary Policy Committee has reduced the repo rate by 25 base points. So to that makes 6%. The second consecutive rate cut. This is second consecutive rate cut. So what is the repo rate? That means the interest rate at which Reserve Bank of India lends short-term fund. Repo rate is something interest rate, that is interest upon what? Lending, short-term lending. See, RBI lends to commercial bank. RBI is lending to commercial bank. So for that it is quoting some interest, that is repo rate. Repo rate. So now what is the mechanism inside here? What is the mechanism inside here? It's very simple. See, commercial banks will have government securities. RBI will lend money. RBI will lend money. So as a security, GSEC will be given to commercial bank, will give its GSEC to RBI. GSEC to RBI. So for this RBI will get the GSEC and also will get some interest. So now commercial bank will get the money, and now commercial bank will lend it to common people. See, co- commercial bank has borrowed the money from RBI. Now commercial bank will pay some interest to the borrowed money. That is repo rate. That is repo rate. Okay. So when this repo rate has decreased, see, based on this repo rate only, commercial bank will fix the interest rate for the public. That means interest rate for the loan. See, we shall have a clear discussion here. First thing, RBI is going to lend the money to the commercial bank. Lending. So let us say the interest rate is 2%, for example. Now the commercial bank will give the surety as GSEC. Now see, commercial bank will lend it to public. Now this 2% of the interest should be paid by RBI. So now commercial bank will fix the interest rate more than 2%. That means 3%. Let us say 3%. For that means commercial bank also will look for profit rate. So now you can understand what are all the effect of repo rate. If the repo rate increases, the interest rate for the commercial bank also increases. When your repo rate decreases, the interest rate, lending rate, that means you can say the lending rate is also decreases. See, let us come to the conclusion. When repo rate reduces, because this is good news, right? When repo rate reduces, bank reduce the lending rate. That means if that if the bank reduces the lending rate, more people will come to borrow money. So consumer will borrow more money from the bank. Okay, encourages borrowing. And when borrowing is increased, the investment and business also increased, and purchasing power also of the people will also increase, and economic will stimulate. Economic growth will happen. If the see When the repo rate is reduced, economic growth will happen. When the repo rate is reduced, economic growth will happen. When the repo rate is increased, the money supply, see, when repo rate is reduced, the money supply in the public is increased. When reduction of the repo rate will increase the money supply in the public. When increase of the repo rate decreases the money supply in the public, opposite to the reduction of the repo rate. That means if we increase the repo rate, the RBI increases the repo rate, and commercial bank also will increases its interest rate. Now borrowers will decline. Now money supply will decline. So money supply will decline means purchasing power also will decline. So now this is the function of repo rate. So what are all the other monetary policy instruments with respect to the discussion? That is cash reserve ratio. See, cash cash reserve ratio. It's very easy. See, these are all basic concept you could have studied in your in your classes itself. So cash reserve ratio. What is cash reserve ratio? Portion of total deposit ba- deposits bank must maintain as a reserve with RBI, thus earning no interest. CRR, they will say CRR. A bank must maintain a certain amount of money as a cash reserve ratio with RBI. So they will deposit their money. Well, for example, if a bank has 100 crores, they will deposit some 10 crores to the RBI. For this, they won't get interest. That is cash reserve ratio. What is statutory liquid ratio? What is statutory liquid ratio? So it is a percentage of bank net demand and time liability banks must hold in liquid asset. See, bank, what is the job of the bank? Lending money. What is the primary job of the bank? Lending money. For lending money, they should have some amount. That is, they should maintain some amount. That is statutory liquid ratio. What is repo rate? Just now we say that rate at which RBI lends short term loan. See, now I am saying, see, I cash reserve ratio is a proportion of total deposits bank must maintain as a reserve with RBI. Statutory liquid ratio, it is inside the bank itself, but it is in liquid term. So net demand and time liability must hold in liquid asset like government securities. Now, what is repo rate? See, if bank needs some urgent money, so they will go to the RBI and they will ask the loan for short term. Now the repo rate will apply. RBI will lend money to the bank, commercial bank. That means you can, for example, you can say SBI. SBI needs money. Suddenly SBI falls into crunch. They needs money. So SBI will go to RBI and they will ask money. And RBI will give the money on the basis of repo rate. For that, earlier itself I told GSEC is a mortgage instrument. Now, reverse repo rate. What is reverse repo rate? See, reverse repo rate is very easy. Rate at which RBI absorbs excess liquidity from the bank. Bank itself having more money. So now, commercial bank, for example, SBI bank is having more money. Now, RBI will ask SBI to deposit its excess of its money to the RBI. So to observe excess liquidity from the bank when they deposit surplus fund. Now it will give some interest to the SBI for the depositing money. That is reverse repo rate. So it is reverse right. Now RBI is getting money from the bank. So that it is reverse repo rate. So reverse repo rate is expansionary monetary policy or contractionary monetary policy. It is contractionary monetary policy. So see here, when reducing the repo rate, it is expansionary monetary policy. When increasing the repo rate, it is contractionary monetary policy. See, the UPSC will ask such questions. What is bank rate? Then what is bank rate? It is very easy. Rate at which RBI provides long-term loan. See, repo rate is short-term. Bank rate is long-term. Repo rate, short-term. Bank rate, long-term loan to the commercial banks. What is open market operation? It is also one PYQ. Directly, they will ask buying and selling of government securities by RBI to regulate liquidity and money supply is called as open market operation. See, government securities. So, buying and selling the government securities and regulating the monetary supply and liquidity ratio, liquidity in the uh, economy is termed as open market operation. What is liquid adjustment facility? Framework for RBI to manage short-term liquidity through repo and reverse repo. See, what is liquidity adjustment facilities? A framework. It is used by RBI to manage short-term liquidity in banking system through repo and reverse repo operations. See, this repo and reverse repo operations is termed as liquid adjustment facility. What is marginal standing facility? This is very much important. Allows the bank to borrow overnight fund from RBI against government securities during short-term loan. Marginal standing facility. See, they will always, if the bank is some some need some urgent money, so for 1 or 2 days, so they will go for marginal standing facility. Allows the bank to borrow overnight fund from RBI against government securities during shortage. Okay, so these are all the part one, of monetary supply. Now, based on this, see there are multiple number of PYQs with respect to this. So we shall first discuss concept, and after model MCQs, and then PYQs. Now based on this, what is the based on this we can have some model MCQs. First, which of the following statement is correct with regarding to monetary policy? It decides the RBI benchmark interest rate. So yes, it has 12 member body. No, it is 6 member body, including governor of RBI. So it is 6 member body. Okay, so 2 is wrong. Now it functions under chairmanship of Union Finance Minister. No, RBI does not functions under Union Finance Minister. RBI functions under Governor of Reserve Bank of India. It does not, it comes under Union Finance Minister. Statement 3 is wrong. Okay. Now, question number 2. The repo rate is a rate on which the other banks borrow from the Reserve Bank of India. Yes, statement 1 is correct. Now, second statement. The value of 1 for Gini coefficient is around country implies that there is a perfect equal income. See, value of 1 is what? Perfect inequality. Value of 1 is perfect inequality. It is not perfect equality. So, statement 2 is wrong. Okay, so now let us move on with these other monetary policies and model MCQs. See, it is going to be most exhaustive and it is most important discussion also. So you will get, surely you will get more answers. Okay, so let us start with the discussion. Let us continue with the discussion. So there are more monetary policy instruments. We just saw there are more monetary policy instruments like marginal standing facility, repo rate, reverse repo rate. There are quantitative and qualitative measurements. Quantitative and qualitative um, measures to control the economy. So first of all, we can have some PYQs discussion so that you will get clarity regarding the monetary policy. See how they are asking the question. See, in India, which one of the following is responsible for maintaining stability and controlling the inflation? Very easy, 2022. It is Reserve Bank of India. Reserve Bank of India is controlling the inflation. Reserve Bank of India is controlling the inflation. Again, consider the following statement regarding Reserve Bank of India. It is a banker to central government. Yes, it is banker to central government. It formulates the administration monetary policy. Just now we saw RBI formulate the monetary policy. It acts as an agent of the government respect of India's membership of IMF. Yes, it is correct. For it is an agent of in IMF. RBI acts as an agent of Indian government. It handles the borrower program of Government of India. Yes, it handles the borrower program of Government of India. Why it is called bankers of bank? RBI is called bankers of bank because it lends to the bank. Other banks retain their deposits with the C. It's very easy. Why it is called as bankers bank? It's very simple. Public deposit their money at bank. Bank deposits their excess money at RBI. Then it is bankers bank. The RBI lends the funds to the commercial bank. Yes. So because this only they are called access bankers of bank. So RBI advises the commercial bank on monetary policy. Yes, all three are correct. All three are correct.